All right, everyone, thanks for joining us tonight. Really appreciate it. My name is Eddie Ackerman. I'm the finance operating partner here at Thomvest. I'll tell you a little bit about Thomvest in just a minute here. Before we kick things off, I want to introduce Rajiv from Spendflo. If you can give everyone an idea of what all these Spendflo banners mean.
Let me just introduce myself. My name is Rajiv, one of the co-founders of Spendflo. And what we do at Spendflo is we help companies save up to 30% on your technology spends. And the way we do it is primarily through two levers. We know that technology spends are increasing about 25-30% year on year for most companies today and getting a little bit out of control. So we help you get complete visibility on your spends, and we have benchmark data of SaaS tools around the world. So we know what product to buy at what price, from who, how to structure a contract that will help you to save money on your current spends. So leveraging that data, we also have a team of buyers who will help you to negotiate and restructure that contract to give you guaranteed savings. So the game is very simple. Today, you're spending X on SaaS. We can come in, take a look at your current spends. We can tell you how much we can save for you even before we sign a contract with you. And we also give you full visibility on your stack, full visibility on your usage. You know what ROI you're getting out of your tools right in front of your eyes through our dashboards. So that's what we do, and very happy to have all of you here. And the reason why we are doing such an event in partnership with Economist, etc., is for us to get more knowledge on the finance field to everyone else and co-create playbooks that will help all of us come through the difficult time that we are in. So yeah, thanks a lot for coming.
Thank you. So you can get debt from Bryce and then use Spendflo to make sure you don't need more debt in the future. So thanks so much for that, Rajiv. And as promised, I'll tell you a little bit about Thomvest as well. We're a 750 million AUM fund. What makes us unique is that we have only one LP, and that's Peter Thompson from the Thomson Reuters family. We focus primarily in cybersecurity, cloud infrastructure, fintech, and a few other categories as well, but those are the primary ones. And as I mentioned earlier, we have an awesome evening planned for you guys tonight. We're gonna have a fireside chat with Phil, chief economist at Flexport, and then we're gonna follow it up with a whiskey tasting with Matt Watabi, who is a sommelier and also a whiskey judge in San Francisco. So that should be fun. We'll be able to drink our sorrows away after hearing about the economy. So that's the plus side here. So with that, I'll introduce our guest of honor tonight, Phil, who is, as I mentioned, chief economist at Flexport. He's previously served on different teams and committees for President George W. Bush, Condoleezza Rice, and also have been in congressional hearings, too many to count probably. But with that, I'd like to give a warm welcome to Phil Levy.
Well, thank you very much, Eddie. I do have to say as we start, I thought this was going to be whiskey and then wisdom. Reversing that seems like it raises the bar quite a bit.
It does raise the bar.
Okay.
So maybe we'll just kick it off with sort of a higher level question. We see what's happening with the bond yield curve. We see what's happening with interest rate increases. It sort of gives you the perception that there is a recession coming. But at the same time, you get numbers such as the non-farm payroll headcount coming up by 500,000. You get retail spending going up by 3%. I think that came out 2 days ago.
Yeah.
So are we in a period where our economy is still growing, still buzzing, or is there a contraction looming?
So both. I think that the economy is still growing, and we're going to have a contraction coming. But let me illustrate a bit of this.
Sure.
We colluded, of course. All right. Here's the first part we started with, the premise. What's happening with like inverted yield curves. So here we have the 10-year Treasury minus 2-year Treasury constant maturity over a really long time period. Why do we care? If you look, it's been a pretty good predictor of when recessions came about. So if you look at when this thing inverts and it gets negative, those vertical gray bars are the way the St. Louis Fed marks off. Those are recession eras. And so you look, you dip down recession, you dip down recession, dip down recession, and you're not getting an awful lot of false signals in there, right? This is the classic joke about, the economists predicting 10 of the last 5 recessions. This isn't doing that so much, that it's actually pretty consistent, and whoa, look where we are. Not just a little bit negative, but negative like when I was in high school or something. So it's really dramatic. I would note this is not a magic formula. It's about why. It's sort of fairly straightforward math that, the yield on a 10-year bond is supposed to be sort of the geometric average of the yields all the way through. What this is just saying is that people think that yields are going to go down, right? Now, that often has a lot to do with a recession, right? You think the economy is going to slow, whether it's because of the Fed or whatever that they're going to do. So that's what this is showing. And there's a bit of a disconnect here where, and I'll come to this a couple of times, where the Fed is saying, no, we mean it. We're really going to tighten. And the market's like, yeah, right. I'll show you a couple instances of it. But this is why I wasn't just being facetious with the, this or that, yes. That at the moment, we've got growth. So I'll show you this in a couple of ways. This is a version where the really familiar line is the blue dashed one, and that's real GDP growth. The two lines pretty much move together. The blue one's just a little bit noisier. The green one is real final sales to private domestic purchasers. It takes out some stuff with inventory, it takes out some stuff with trade, it kind of gets it right down to consumption. And you'll see, especially in the sort of recent era, it smooths a bit. The blue line is kind of waving around. So what do we see? We see, obviously, with the pandemic, you had a deep plunge, you had a really sharp recovery, and then we've had a gradual settling down, but it's settling down above zero. So things are looking relatively flat. So it's not a big recession or things crashing yet. This is my interpretation of the retail sales numbers. I think the ones, you mentioned 3%, which you're absolutely right, that was the headline announcement. A couple of problems with that. One, it's nominal. And two, it is a very noisy signal. So what I've done here is try to say, let's look at the 3-month periods, look at like the latest 3 months versus 3 months before or a year before. That's what I call them, sort of quarterly or annual. Annuals in red, quarterlies in blue. Not annualized, but the quarterly one is just for the quarter. And I also deflate these things. Interestingly, by the way, goods inflation has mostly gone away. And you see this when you deflate these things, that if you deflate the last 3 months over a year earlier, you use CPI this is a very long answer, sorry about that. You use CPI for commodities, less food and energy commodities, you get 2.4%. But the quarterly one, the last 3 or this, it's actually negative, it's deflation for commodity prices, if you take it that way. Anyways, you're right that you do see over the last year, it's like 2.1%. Over the last 3 months, over 3 months is about 0.6%. But it's positive. It's a similar story. This is in real terms. So you do get some of this. This was the part you mentioned where we actually think it seems a little bit hotter than that zero number we looked at. This is the labor market. 2 different views of the labor market, which have not entirely aligned, but mostly aligned. The one that's most familiar is the one in black, and that's using the left-hand scale. That's the unemployment rate. This goes back to December of 2000, which is when the other series starts. So you can see just how low this is. We're in territory with about 3.4% unemployment, where we haven't really been there. That's an incredibly hot job market. And then the other one says, sort of hold my beer, it's even hotter than that. Because the other one looks at how many unemployed people are there per job opening. There's some economic work which argues that that's a more reliable signal. They're not telling fundamentally different stories. That one has just said the market's even hotter than this. We're at a point now where it's essentially 2 jobs per unemployed person, give or take a little bit of rounding error, which is a very, very tight labor market. That doesn't look anything like an economy in contraction.
So a lot of economists also mention that there might be a talent gap between the job openings and the employment. Do you have an opinion on that?
I think that's plausible. It's not really my area of expertise, but I think this has been one of the really big challenges we've had during this whole pandemic time is we've seen the limits for the economy from changing from one sector to another, and just how smoothly can it do that, whether it's from goods to services, and what you just described, where it's not, as you say, it's not that a job is a job. If you've been in the healthcare sector and now you want to go into, I don't know, the clothing,
oil and gas,
something like that. Yeah, that's not an overnight or an easy switch.
Yeah.
So there can be an element of that. But it is also true, these are very low unemployment rates.
Interesting. And you touched a little bit on the CPI and PPI.
Yeah.
Obviously, things came in a little bit hotter in some aspects. In other aspects, it looks like inflation eased a little bit. Do you think the Fed is getting that soft landing we talked about? Are they curbing inflation?
No.
Elaborate.
Yeah, I don't do this like, I need a one-handed economist thing. I like having both, but in this case, I'll try and give a straight answer, then I will elaborate. This is actually, here you get the US in blue and you get Europe in green. So let's just talk about the US for the moment. The solid blue line on top is the one that sort of tells the happy story that you're suggesting, which is a very common happy story, which is we had inflation, it really started kicking up, say at the beginning of 2021. It peaked at these sort of somewhat shocking levels, around 9% inflation. This is CPI. But then look, it's very comforting, it's dropping right back down. Okay, I'm gonna give you another version of the same thing. Now look at the blue dotted line. The blue dotted line is a different measure of inflation. This is the trimmed mean PCE that the Dallas Fed puts out. It's kind of like core inflation on steroids. That it's rather than just taking out food and energy, it's looking at the personal consumption expenditure deflator, and it's taking out everything it thinks was volatile. What you see on that is it kind of went up, and you're not seeing anywhere near the dive at the end. It didn't go up as much, it wasn't as gaudy. It sort of stayed at the 4.5 to 5 level, but it hasn't really gone down that much. And you actually see the same stuff if you look at the CPI numbers. I just said, how could I not be happy because I just told you that goods inflation had largely gone away. There's a rotation here. That if you looked at this stuff 9 months or a year ago, you would have seen goods inflation at about twice services inflation. Now you see almost very, very little goods inflation. The latest CPI report, I think, had 1.4% year over year, the last 12 months for goods, if I remember. But services is a lot higher. And not only is services higher, it's steady. And the thing to remember with this is we are predominantly a services economy. We're something like 2/3 services. So if you get high, steady services inflation, and some of those numbers are holding, like shelter, are holding around 7% inflation, that's not going to make the Fed happy.
Is that also what the Fed is looking at?
And that's why. That's exactly why. Exactly. So I'll show you, here's one way to tell the difference. I said that CPI started kicking up at the very beginning of 21. Well, the Fed didn't start tightening then, right? The Fed waited. Here's inflation climbing up, and they said, nope, we're not doing anything. When did they start doing stuff? Well, pretty close to the time when the trim mean PCE started going up. Because I think part of the initial theory, and the Fed said this, so this doesn't take an awful lot of analysis on my part, was, this was temporary, it was volatile, and it's exactly that difference, which is we're seeing the spike in things where they think it's going to get better, whether it's food or energy. They had hypotheses about the logistics sector and a crunch in logistics being the cause. It was when you started to see the more stable elements go up, that's when the Fed acted. And I think that's what they look at. The other thing, by the way, in terms of why, I think I'm paraphrasing your question as, will the Fed be satisfied with all this? Mm-hmm. Here's the other reason why the answer is no. We shouldn't get confused between inflation stability and price stability. So the Fed's mandate, so I'm going to define these. Inflation stability is we don't have rising inflation anymore. All that ascent is not happening. So we kind of leveled off. So inflation looks more stable. What is price stability? The Fed's pretty much defined it, 2%. But that's this horizontal line right down here, and you're seeing that none of these curves are anywhere near 2%. And so that's what the Fed is worried about. And so the fact that these things have leveled off, that's not the point. And I guess I would also argue the Fed is not going to be patient and say, well, you got a nice little downslope there, give it a couple years, it'll get back. There's a reason they won't be patient. And the reason is they're very, very worried about inflationary expectations. So there's the question, it matters for actual inflation, what do people think inflation is going to be? If you think about people in your company or in companies and you say, hey, you're getting a 4% raise, do they say, why do you hate me? Or they say, oh, that's great, it's so nice to be rewarded. Well, a lot of that has to do with what do you think inflation's going to be? And if they see a price in a store go up by a certain amount, how do they interpret that? So economists have for a very long time had sort of inflation expectations in their models. What we don't have is a really great story about how those are formed, right? We argue, we do rational expectations models. This is the way you torment graduate students. I've been there, done that. But there's a general sense, the longer you hold at high inflation levels, the more likely it is that people adjust their expectations upwards. So far, the answers are a little bit all over the map, but so far, those inflation expectations, when you say, what do you think is going to be in 3 years, they're not bad. The thing that worries the Fed, the reason why you've actually had a couple Fed regional presidents saying, maybe we should have done 50 basis points, not 25, is because they're not happy sitting around 4.5, even if you're looking at trim mean PCE. It's the longer you do that, you're playing with fire. And you're going to get something where once those inflation expectations get built in, now you need to do a lot more nasty, painful work to work them out. And then you need to have a steeper recession, by which I mean recession, and a real downturn.
Do you think the recent 25 bips increase should have been 50 bips? They went from 75 to 50 to 25. Do you think they're a little too light on that right now?
Hold on, I have a thing. This is what they've been doing.
Prepared for every question.
I do my best. I'm sure you'll get me out on something. So the green line up top here is the nominal Fed funds rate. And so this is going back to, 2017. So it's going back for a ways, just so you can put it in perspective. We had things rise. They sort of hit that zero lower bound. We did that for most of the pandemic. That's a fairly steep ascent, right? What you have with nominal. I don't have a fine-grained enough way to say, 25 is much worse than 50. The challenge, a couple challenges the Fed is facing. One, as general rule, I'm going to argue for doing things in real terms instead of nominal terms. And so if you subtract off that trim mean PCE, you get the blue line. Oh, wait a second. We've been looking at negative real interest rates, even with this fairly conservative measure. Remember, that was when it was well below the CPI measure. So it's been coming up less negative, but you could argue that up until now, it's not so much they've been slamming on the brakes, they've been sort of steadily letting their foot off the gas. The other real problem that they have with this, okay, I'm going to keep adding problems. I'm not going to commit to a number in advance.
That's what the whiskey is for.
Exactly, thank you. You all are supposed to be losing count of these things. Big problem is nobody really thinks that Fed policy works overnight. The general presumption is that everybody sort of clings to Milton Friedman's term of long and variable lags, which means we don't exactly know, but it takes a while. And so if you press somebody for rule of thumb, think something like 18 to 24 months. Well, this is why I'm hesitant to answer your question, because the difference between do you do an extra 25 basis points now or in 6 weeks, if you think that these things aren't going to actually hit. By the way, note, we haven't really had the Fed tightening for 18 months yet, right? It was March of last year. So you see some things tighten a bit as people are or are not buying what the Fed is selling. I would argue one of the problems they're having is people aren't buying it. And yes, I have a chart for that. This is something the Chicago Fed puts out, which caught my eye. This hadn't even been in my deck before a week or so ago. I accumulate these things. This is the Chicago Fed Financial Conditions Index, where they look at a whole bunch of things. I'm guessing that all of you, or many of you, do sort of great financial things, and almost none of you is directly dealing with the Fed funds rate, right? You're dealing with other things which tend to be based off of the Fed funds rate. If you go buy a house or a property, you're doing the mortgage rate. These other things move. The general presumption is that as the Fed raises rates, all these other things will move in line. They haven't been. And that's what this is picking up, is the Chicago Fed is looking at something like 90 different measures of financial market tightness. They normalize it all so that above zero, the thick line here, represents tight, below zero represents loose. So you saw this tightening, which was right as the pandemic kicked in. Sorry, these things have different time scales, so I'm just going to orient with this. You saw things get really loose as they took their balance sheet up to like $9 trillion and dropped rates to zero. Then you saw they've been tightening, and it gets up almost to the point where it's neutral, but then look what's been happening in the last few months. It's loosening again. And that's a problem for them because they're really trying to sort of squeeze things, slow it down. We talked about how tight the labor market was, and people aren't buying it. So what do you do if you're the Fed? Well, you don't have an awful lot of tools, right? You can sell off your assets. You can keep raising interest rates. You could also do different communication strategies, and that's part of it. So you're getting a lot of them out there saying, no, we really mean it, higher for longer. But this is what I use to back up my claim. So far, markets aren't really listening to them.
There seems to be quite a disconnect between Fed's messaging and actual perception.
Yep.
Even looking at some of these charts, it's different than what I was reading online. I came in here feeling a little bit more positive. Now
you knew I would bring that down.
Yeah, I knew you'd be here.
Yeah.
Also, I just want to quickly tell folks, if you have any questions, we do have a slido.com. So you can go there, put in that number, 3021-727, ask your question anonymously. We'll also open it up at the end for Q&A for anyone who's interested. But if you have a question you're embarrassed to ask, you can use Slido for that, and I'll get it right here on my tablet.
I won't even know who to mock.
Yeah. We'll just look at someone random.
Yeah, that works.
So for the longest time, we're talking about the Fed, the disconnect. For the longest time, they were, telling us that inflation was transitory.
Yeah.
You showed us a graph that sort of gave us that perception. What do you think they got wrong, and how did the supply chain, bullwhip effect come into play here?
Yeah, that's a good question. So I've argued against this. I've argued that it wasn't the transitory. I think part of the transitory theory was that supply chains broke down. And, I will sort of mockingly call this somebody's got to go down in the attic or down to the basement and flip the switch, right? But then it'll all be fine again once we fix that. And then that's transitory, right? You fix it, it's good, and the circuit breaker, whatever it is. One of my very, very favorite charts of all. Yeah, I'm a geek. I love it. This is what happened to personal consumption expenditures. And it looks at the three categories. Note, I've kind of made it look like all these categories at least were equal in this pre-COVID era. The vertical thing was right around the onset. This is the recession. Like they're equal. They're not. Services is about 2/3, like I said. Of the remainder, non-durable goods is about 2/3 of the remainder, and then what's left is durable goods, those that last 3 years or more. And so this is how we sort of it's a good way to trace out what happened and what was particularly strange about the economy during this pandemic period. So what's nice is we have kind of a reference point here for what normal should look like, what we kind of expected normal to look like. And that is this dark blue line, services on the bottom. So you have a shock. Services drop significantly. I've normalized this all so you can see they drop about 20%. Right? Big shock to the economy. And then over a period of 3 years, they gradually work their way up until they kind of just get back to where they were, about the beginning of 2022. And sort of steadily moved. Note, by the way, in sort of normal before times, these curves did not swing all over creation. And so businesses weren't set up for this. Logistics was not set up for this. We weren't ready. So what happened? Let's look at the other two curves, which are the ones that use logistics, the sector I'm in. They kind of went crazy. I mean, if you look they did an initial dip, but look how fast they recovered. By the time you were getting to May or June of 2020, goods consumption was back to where it had been pre-pandemic. And then it kept shooting up from there, shooting all the way to the point where if you look at durable goods, the top line, it's up about 35% over where it was pre-pandemic. So what I would argue is, and it backed off from that, but it backed off to a level where we're still at about 25% over where we were pre-pandemic. Non-durables would be really impressive if it weren't sitting right next to durables. Even that didn't spike as much, held fairly constant. It's sitting about 10 to 12% above where it was. These are real numbers, by the way. So what did the Fed get wrong with all of this? It's a very different thing if you had, the circuit breaker that went out in the basement and you need to go flip that, versus you have a system that's overwhelmed. It's a system of finite capacity and people are just demanding more stuff than it can deliver. I mean, this actually was delivered. The system did deliver this much, but you weren't expecting to do 35% more. So that was one thing they got wrong, which, okay, that was sort of a fundamental conceptual thing. There's another thing where I will forgive them completely because nobody quite understands it. This durable goods line is really weird. I mean, like I said, durable goods are the things that are supposed to last 3 years or more. So think about sofas, exercise bikes, big screen TVs, all of that stuff. How many sofas does everyone need, right? The general thought is if you accelerated, you buy these things all sooner. That was part of the transitory argument, was that they were seeing this stuff in durable goods and thinking, well, if you're way above the norm early, surely this is going to drop back down here where somebody says, well, I already bought the sofa. I don't need to buy one again next year, and the sales drop. They just haven't. And that's one we don't have a good answer for. Ooh, we had the daring person.
Go ahead.
I'm presuming this chart is not controlled for inflation.
It is. This is real. Yep. No, you're right. And actually, I even have a chart for my charts. I was going to show you. This is one which I'm doing on trade flows, which is not only relevant, but it shows your point. Up until right after the pandemic, which we had such low inflation, it didn't really matter which one we did. In each case, the solid line is real, the dotted line is nominal. But your intuition is right. You want to check very carefully because what you start seeing is a big divergence there, where you start telling really different stories if you go with nominal instead of real. And now it's getting even more complicated because you have to think about, am I deflating the right thing? Like I told you, goods versus services being very different now. The other reason why I wanted to show this was the top line, the solid blue, is US imports. It dipped with the pandemic. It rebounded. Note that it had kind of been drifting down a bit pre-pandemic. I'm only talking about real here. But then look, we had fairly steady growth in imports. Again, this wasn't a system that failed where, hey, we can't deliver stuff. It just couldn't keep up with the extent to which there was this sort of huge demand. And so I think that's the part that the Fed got wrong in this, was thinking that it was a breakdown and the breakdown was going to recover, and instead it was kind of good old-fashioned excess demand.
Interesting. Any other questions?
Got one right over here.
Right over here.
Like, why are people still buying couch every 3 years? Like, I understand, when, perfect example is when SF shut down, we built a home gym. I'm still using the same treadmill.
Yeah.
I don't know anybody else who has 3 treadmills in their home gym.
Yeah.
We accelerated that demand. I never would have built a home gym, but I have it now.
Yeah.
But I haven't really bought anything since I built that home gym.
Yeah. I can come up with all kinds of good theoretical reasons why this should not be happening, but it's happening, which is really uncomfortable. What I can tell you is we've dug into these numbers a little bit more. You might have had, one hypothesis you might have is maybe there's some crazy subsector of durables that's driving all of this. That doesn't actually work very well as an explanation, because when you look at the numbers, there's nothing that really stands out. They're mostly moving in parallel. I mean, cars looks weird because cars really did have supply problems. So the best explanation I can give for this, it's not a very good explanation, but I haven't heard better, is when you have, for example, negative real interest rates, if you're trying, and you've got a lot of money and you're trying to save, the best thing you might do is advance durable purchases. So I'm wide open to better explanations on this. I've talked to a lot of government economists and others. Nobody has a good answer on this one, that at least that they've shared with me.
Have you ever seen a trend of consumer, like, there's $1 trillion on credit card debt in
Yeah.
the US? Does that correlate really well? People are just buying shit they don't need. Is that really what's going on?
I don't have the credit card numbers. You see, there is something I don't have on a slide. What I do have is, I think what you're getting at is an excellent question, which is what drove all this stuff? I mean,
Where's money coming from? Like, what-
exactly. Follow the money. Where did this come from? How were people able to buy all this stuff? Okay, this is at least for a while, how did you buy all this stuff? I agree with you. We're actually looking into one of my guys, I read the Flexport research team. One of my guys is trying to look at rent to own, buy now, pay later, credit card stuff. So we are following this. It's a great question. I just don't have that answer yet. Watch our site. But this will explain a lot of what happened early on. So the top line, real, the top line on this stuff says what was personal income, real personal income. And what we there's a difference here between what we would have expected to see and what we actually saw. So this is starting in January 2020. So we know that within a month or two, you get this really severe recession that hits, right? Services down 20%, I showed you guys. Wait, where's the dip in income? It doesn't happen. That if you look, from about March of 2020, we never got down to the income level that we had in March of 2020. We went up from there. Very, very strange for a recession. That normally the thought is these things drop, and it didn't. Okay, why? Lines down below. The lime green one is real government transfers. Ooh, look at the nice correlation between where that thing spikes and what happens to the real income and how that spikes. And actually those spikes will also work really nicely if I lined them up with some of these consumption surges. The other thing to note with this is people didn't spend all of it. The bottom line here is real personal saving. And so there was a lot saved away. And I'm sure you've seen reports where people are trying to track this and say, how much is left? How much of a war chest do people have? That's some of it. So there is a bit. You see things kind of level out. We don't get quite the shocks that we get later on. You also can get a rotation from I needed the government, I needed support, to, hey, wow, this economy's humming. There's 3.4% unemployment, I can get a raise. And so there's some of that coming in too. That's why your question was so good, though. If it's all borrowed, if I'm trying to just sort of keep spending and doing credit card debt, that does suggest that there's a bubble there and that this will bring an end to it. So definitely something worth watching. Don't have the answer.
We have a question from Andrew back there. Might have to speak up.
Yeah, kind of building on Gagan's couch theory.
I'm going to quote that.
I would, as Flexport, I'd be very curious because what my pet theory is that due to sort of structural reshifting from offshore to onshore, that we're starting to see greater aggregate demand because a lot of people who, to the employment numbers, who were working part-time retail and still living with their parents are now able to secure a slightly better job, move out, buy a couch, and it creates an aggregate demand cycle that is being driven by things like, hey, that supply chain to China is no longer frictionless. Hey, sourcing components by moving boxes around the world doesn't always work. And by driving some of that growth in jobs back to the US,
Yeah.
you're seeing greater aggregate demand.
Okay, I like your theory. It's cool. I don't agree with it, but it's a really, really good attempt. Let me tell you why, though, I have some skepticism about this. So several reasons. One, this premise that, well, we're nearshoring a lot is not in the data.
Okay.
That if you looked, I had shown earlier on the trade numbers that it's not that we stopped importing, we actually increased our importing on these things. You might say, well, yeah, but that's all Mexico and Canada, it's all nearshoring. All right, we did another piece that's on the website where it's not really there in the data. It's that you saw a lot of moves. You did see moves out of China. They often ended up in places like Vietnam. So you didn't really get the difference there. The other reason why I question this is prior to the pandemic, the ratio in which people consumed goods and services was pretty near constant. I don't take this back for a bunch of years because you guys don't want to have to see years of a boring flat graph, but it was pretty constant. And then here we get this sort of weird deviation from that, where they're consuming things in very different ratios. We do have an indicator, by the way, this is the first indicator we did to me, which I optimistically called the post-COVID indicator. Still kind of waiting for the post-COVID part. But it's kind of normalizing this, where if we get back to zero, it's going to be the old consumption patterns. I buy it that the kids leave their parents' house, they get some income, they're happy. They used to go out to bars, they used to go out to concerts, they used to go to why are they not doing that? So I buy that they do this and they're spending more. Why is it still tilted towards goods in a way that it wasn't before?
Michael, you have a question?
Yeah, so I was looking, working on some restructurings prior and during the pandemic, looking a lot at, some services businesses and hospitality. And there was, a lot of conversation around pent-up demand there. How does a durable good explosion compare to the forecasts? Some of these companies have.
You mean, did they see this coming with durable
Yeah,
goods?
anybody. I mean, we did. I think in hospitality and travel,
Yeah.
we're just waiting for the thing to end, and we're like, okay,
Right.
we know there's pent up demand here. Why the durable goods?
I think this has been a huge problem for businesses because we normally forecast things by I can identify past patterns. When they're all flat, it's pretty easy, right? You extend straight lines. We also do it when there's sort of cycles, right? How do people normally? A fundamental problem here has been we don't have like, hey, look at the last 3 modern major pandemics and see how everybody behaved. We don't have them. So we can't follow patterns. A lot of the forecasting that my team is doing follows we are forecasting that post-COVID indicator, we're forecasting trade flows, and we're forecasting consumption at a fairly detailed level, by the way. We just came out with new forecasts today. We're doing something different. We're actually doing sort of momentum forecasts augmented by Flexport data. And so we're going out somewhere between 3 to 6 months on these things, but not the not the kind of things you need to do for investment. And it's not because we don't care about you all, we do. It's because you just can't see that far out. You don't know what the patterns are. And I think this is the problem that a lot of businesses have had, which is you need to make investment decisions. You need to think, how am I positioned? And you've seen a lot of businesses get it wrong, right? Whether you thought, I won't name particular companies, but I gave an example of like exercise bikes earlier. You can get on the wrong side either way. You can say, hey, look, I don't think this craze is going to last, and all of a sudden you're out of stock when everybody really loves your product. Or you say, I'm going to build a big factory. I'll be ready as this thing continues because now everybody just loves us, and then people turn away. It's just been because of this behavioral stuff where it's just sort of really different behavior. This whole graph should have been more or less a straight line at 0. The way this is calibrated, which is it's the ratio of goods to services, then was kind of recalibrated. If it had been, if I showed this to you for about the 4 years pre-pandemic, you'd see it more or less sitting at about 0. And so this was what I came up with as like the best sort of behavioral indicator we could do for how weird is this. And the problem is there's nothing here which is like, oh, look, that's an obvious sine curve, or it's how do you forecast this out? So, which is a very long-winded way of saying we don't know.
Right. So one question regarding the Chicago Fed graph you showed where the markets are not listening to the Fed.
Right.
And why do you think that's happening, especially like the equity market that we saw rally in the first month? Why are people not buying that Fed will continue to raise rates and keep it at a higher level? Like Economist today came up with the fact that inflation is going to be here for even 2024. So what is the optimism in the market?
Well, first, let me just say it's a really sad state of affairs if all of you people with your expertise are asking me why markets are doing what they're doing. That said, with all humility, I mean, I think there's the standard thing is what you've seen for a long time. People don't generally have a lot of experience to draw on all this. We haven't really had a contraction for a very long time. The economists who are arguing about this stuff are seriously having arguments about, so what do we make of the 1970s? Right? Because it's, people who have done all of their estimations over the last 35 years are like, well, we haven't really seen inflation. So, hey, guess what? Nobody worries about inflation. Yeah, because there wasn't any. And so then you're trying to go back and, are the 70s relevant? That inflation built up slowly. It didn't build up quickly. That they're literally, you can look at the Peters Institute website. They're having serious arguments about these things. I think that's the problem. I would suggest that potentially market participants are more myopic even than economists. And so if it hasn't happened in the last 10 or 12 years, you've all rotated through. Those of you who did really nicely, you go and you get on advisory boards and do other things. And the people who are sort of in there are like, I've never seen any reason to worry about this. The Fed put, it's all great. That'd be what I would suggest. But that's a humble attempt.
Perfect. Thank you so much, Phil. Really appreciate you joining us today. Let's give Phil a quick round of applause here. He makes my job extremely easy because I just ask a question and then we get 14 slides and a good answer. And once again, thank you, Phil. Really appreciate it. He'll be around here. Feel free to ask him questions. I'm offering you up.
I'm happy to.
Brilliant mind and really appreciate you coming. So thank you.
Thank you. Appreciate it.